at some point, and I think that this rebound will happen. But thereafter, what is the upside potential? I don't think you will see for a long time new highs in equity markets. I'd also like to point out that bear markets can occur in different ways. In the US, in the last 100 years or so, we had 3 major bear markets in real terms, that is inflation adjusted. 1906 to 1921, 1929 to 1948, and 1966 here to 1982. By 1982, stocks in real terms had declined by 80%. And they were no higher than at the beginning of the century, inflation adjusted. The market 1964 to 1982 traded in a trading range between, say, 700 on the Dow Jones to 1100, up and down every year by 20%, relatively high volatility. But then here we had this collapse in the market by 70–80% in 82, and in 82 stocks were unbelievably cheap. Now, in 1990, the market wasn't terribly expensive in real terms, if you look at here. But now, obviously, we had a very expensive market in real terms in year 2000. Then we dropped, but then we made a new high. So in real terms, we're actually still very high. And I think in real terms, usually the bear markets in real terms, on average, they lasted 16 years, 1/6. And the starting PE was usually around, starting price-earning ratio, usually around between 15 and 20 times earnings. And the terminal PE at the end of the bear market in real terms was 6 times earnings. So I think that actually, even if stocks don't go down a lot in nominal terms, that in real terms they will be relatively unattractive for quite a long time. Now, I mentioned earlier on that the dollar is likely to collapse. The question is against what? The dollar has already collapsed meaningfully against the price of gold. Gold was in 1999 at $251. It's now, say, around $840. So the gold has significantly outperformed the dollar. And of course, it has also outperformed the Dow Jones. Here you have the Dow Jones, which was in year 2000. You could buy 44 ounces of gold with 1 Dow Jones. Now you can essentially buy just 10 ounces of gold, a little bit more than 10 ounces. I think eventually you'll be lucky if you can buy 1 ounce of gold with 1 Dow Jones. So I'm not saying that gold will go up. Maybe it goes down and retests $700, maybe even $600. That is possible in this environment of global tightening of liquidity. But I think that gold is relatively safe, and I assure you, if gold drops to $600, a lot of other things will drop even more, because then we're talking really about huge disruptions in the system and in asset prices. Gold, as you can see, has underperformed the S&P 1980 here to 99. This is a wonderful kind of saucer bottom. And I think from here onwards, the direction will rather be up relative to other assets. Relative. We have to measure everything in relative terms today. If you buy gold and you lose 10% over the last 6 months, it's not as bad as if you lost 50% on your stocks and 90% on your financial stocks in the US. So relatively speaking, you've done well. I mentioned that tight monetary policies are unlikely in the US in the foreseeable futures, maybe forever. We have negative real interest rates on the public sector, on the government's bonds and on government, the Fed fund rate. And whenever real short-term Fed fund rates are negative here, minus, like they are now, very strongly negative because inflation is more than 1.5%, usually commodities and in particular precious metals perform well. What you don't want is high real interest rates. That's when commodities perform badly, and gold, like in the 1980s, we had very high real interest rates and commodities performed badly. But here, basically, I think that the money printer will make sure that precious metals will be attractive in the long run. In terms of themes, I wouldn't rush to buy. Usually when you have this kind of break in asset markets, the economy, the real economy follows, and the question will be how deep the recession is, how long it will last. I would imagine that for the next few years, global economic growth will disappoint, and so there's no rush to buy asset markets. Usually when you have this kind of break in markets, you can have a strong rebound, and then the lows are tested several times again, like in the case of Japan after 1989. But there are some sectors that are reasonably attractive, like healthcare in Asia, real estate in Asia, tourism, then infrastructure. That's where the bottlenecks occur, although there are also some overcapacities at the present time. Farmland, I would argue that in the next war or in a financial crisis, you don't want to own Park Avenue apartments in New York and Mayfair houses in London, because real estate in financial centers, of course, suffers when the financial sector turns down, and so these properties are unattractive. I would rather look at the farm in the countryside. That is an unrelated asset. It has no correlation to the financial industry. So my advice to you is to buy a farm and to learn how to drive a tractor instead of gambling on financial transactions. I'd like to also mention that in the past, for the last 5,000 years, the cities, they offered a certain amount of security in war times. That is no longer given today, because probably the next war will be very devious with biological weapons and with terrorism, but nobody will drop a bomb on your farm in the middle of nowhere. So, I mean, just purely from a security point of view, I would look at that to be relatively attractive. I think the key here is that the central bankers have become hostage to inflated asset markets. As I said, Mr. Greenspan and Mr. Bernanke have managed to do what never anybody before managed to do, to inflate everything in the world, but really everything. And now the Federal Reserves and the other central banks, they can maybe keep the one or the other asset class up, but they can't keep them all up. It's like a juggler. Some things will fall. And I'd like to emphasize, as Ludwig von Mises observed, the dearth of credit which marks the crisis is caused not by a contraction, but by the abstention of further credit expansion. So when credit growth slows down, in a credit-driven economy, you have a major problem. Thank you very much for your attention.